Hi, this is Scott Martindale of Sabrient Systems with this week's Sector Detector column. Well, market timing is tough. Even as stocks rose and we all knew it couldn't go up in a straight line, picking tops is hard. Well, it appears that those previous bullish catalysts are played out, at least for the moment, and the annual ritual of April pullbacks might be kicking in yet again. So what happened? Is it just anticipation of the usual sell in May and go away adage? No, I think it's more the new type of news events that we've been getting lately, rather than the usual financial reports to which investors have grown immune. You know, EU debt, China growth, sequestration, all that. The new news is more in the form of military threats and terrorism here at home, like bombs and poison letters. Hadn't seen that in a while, and it seems like it's paralyzed investors for the moment, and bulls have suddenly lost the mojo that they had apparently regained just last week. The technical breakout of the S&P 500 above its all-time highs has failed, and if you look at the chart, it broke out strongly above the sideways channel that had been in place since early March, and it nearly touched the 1600 mark. But now S&P 500 finds itself testing support at the bottom of the channel around 1535. Still, the Fed's QE3 liquidity spigot continues to flow and has helped support equity prices and the housing recovery. This year's rally so far has really been led by defensive sectors like healthcare, utilities, consumer goods, and even telecom made a late surge. This general investor conservatism is also reflected in the outperformance of developed markets over emerging markets, value over growth, and the popularity of dividend-paying stocks, particularly blue chips. This tells me that investors are cautious but committed to staying in equities, and the selling we're seeing should be contained. Looking at Sabrient's SectorCast fundamentals-based rankings of the 10 U.S. sector iShares ETFs that I track, financial has moved up into the top ranking with an outlook score of 76, and it's followed by technology. Those are the IYF and the IYW. IYF continues to see its score gradually rise, while the defensive sector, consumer goods, saw its score fall a few more points again this week, down to 62 to hold on to third place. IYF took the lead on the basis of its favorable forward PE and strong support among Wall Street analysts, and by that I mean that there are a number of new upgrades to forward earnings estimates. At the bottom, telecom is still down there with the worst outlook score of 0, and it's joined in the bottom 2 again this week by materials, so that's IYZ and the IYM. Materials received a number of downward earnings revisions from the sell side. This week's rankings maintain what I would call an overall neutral tone, although the bias appears to be gradually swinging back to bullish side. It's been neutral for a few weeks now. This week I'm noticing the rise in financials at the expense of healthcare, and so that's a somewhat bullish swing. We're also seeing a tight top-bottom range in the bull scores. The bull scores, it measures how well a particular stock does on particularly bullish days in the market. So that's indicating a high sector correlation on strongly bullish days. Financials and industrials have been the leaders on those strongly bullish days. But the top-bottom spread on the bear scores, which measure the relative safe havens on weak market days, has widened further to 25 points, and that indicates lower correlations on weak market days. That is, it pays to be in the safe sectors when the market is particularly bearish. Utilities remains the favorite safe haven sector. Some top-ranked stocks within those top-ranked sectors of financial and technology. This week I pointed out to Everest Re Group, Citigroup, ValueClick, and Cree Inc. Thanks for listening.